Thank you for joining us today for this introductory event about thoughtful investing. And we'll be discussing what it means to us at Castlefield and also what it means to our investee companies and also the wider financial services industry. And I'm Olivia Bowen, I'm a partner and financial planner at Castlefield, and I'm chairing today's event. And I'm delighted to be joined by Adam Moloney, who's from Blancco. He's Chief Financial Officer there. And Blancco is one of the companies that we invest in on behalf of clients. They're an international data security company and the leading provider of data erasure software. I've also got Amelia and Rory from our investment management team, and they've both joined Castlefield in 2017. Amelia is involved in company and fund research and also does a lot of work on engaging with companies on ethical issues and implementing our voting policy. And then Rory is the fund manager of our European fund, which is a sustainable fund, of course. And he's a poacher turned gamekeeper in that he started his career as an emerging market specialist and was with an expertise in mining companies. But in 2004, he saw the light and he became very much an expert on responsible investment. So we were delighted when he joined us a few years ago. And I just wanted to note that when we talk about ESG in our conversation today, this stands for environmental, social and governance factors. So that's something to bear in mind. So my first question is for Rory. So Rory, we know there are many approaches to ESG and ethical and responsible and sustainable investment and many other different names. So what do they mean and how does Castlefield our approach fit in with these attributes?
Thanks, Olivia. ESG, these environmental, social and governance factors all sit under the umbrella of what is ethical, responsible and sustainable investing. The history of ethical investing really goes back to the 1960s and 70s and is very much aligned with the ethics of the end investors, the asset owners themselves. And ethical investing often utilizes negative screens as a foundation of its process. Responsible investment looks to the concept more of stewardship. That's really the fiduciary duty of the investor and the asset owner when looking at and analyzing potential investments. And then sustainability incorporates a future-proofing angle where we're looking at the sustainability of any given business model. For example, in sustainability investments, we won't see companies in the oil and gas sector or tobacco companies because we just don't see that their business models are sustainable at all. In terms of what we at Castlefield do, we adopt a blended approach with regard to ethical, responsible and sustainable investing. We incorporate both responsible investment as defined by the UN's principles of responsible investment and sustainability themes into our process. Our company background with a large charity client base means we do come from an ethical stance, and our approach has evolved and developed from there over time. We do incorporate a strict negative screen, of course, but exclusion is far from the main factor in our investment process.
Thank you, Rory. That's really interesting. And can you tell us why you consider it important for our clients and other investors to consider ESG and sustainability factors?
Thanks, Olivia. We see it not just as important, it's absolutely essential. If we look at the past crises, there's been a real lackluster adherence to ESG standards, which have destroyed public trust in institutions and indeed the whole financial system itself. The global financial crisis came about through irresponsible lending practices in the main. Environmental test breaches have ruined reputations of car companies like VW. And much more recently, insufficient oversight and governance was very much at play with the downfall of Neil Woodford's firm. On a more positive side, we feel that there is growing evidence over the past years to support the fact that incorporating ESG into investment processes can actually enhance clients' risk-adjusted returns, by which I mean that the return per unit of risk is actually improved by inclusion of ESG factors. We look at all issues of responsible investment and sustainability. We don't outsource these activities as we see them as an integral part of what we do in our duty of care for our clients. On a personal note, it's a real pleasure to work in a team that not only understands sustainable investment issues, but also has a real passion.
Thank you, Rory. So leading on from that, Adam, how prominent is ESG on the corporate agenda? And have you seen an increase in investors asking you about these factors?
Yes, I mean, I've been a CFO of a listed company now for almost 20 years, and I've seen a real change over the last 2 years. I would say probably before that, there would always be a lot of focus on governance in particular, and companies obviously didn't want to fall foul of corporate governance issues or perhaps some regulatory environment, GDPR, whatever it might be. So that's always been very high on the agenda. But I would say the E and the S of ESG have always been a little further down the agenda. And perhaps it used to fall under CSR sections within annual reports where you might want to write something about some recycling initiative that you might have done or some charitable event that you've had. But actually, it's not a really significant change in terms of the way that businesses are operating. That's definitely changed the last 2 years. And a lot of that's driven by investors. So I would say from my experience, we've seen a huge increase in the amount of correspondence that boards get from investors saying, we want to see what you're going to be doing about a climate transition plan, what you're doing about diversity within your workforce and within your leadership teams. You might not necessarily be under pressure to have it fixed there and then, but you need to lay a plan out. You need to give a clear idea of how you're going to remediate anything over the next few years. And there is a threat in many of these correspondences that if you don't do these things, you're not seen as making positive action, they will vote against you in upcoming AGMs. And that really is the power of the investor that really has to force change. And I think some companies will feel that more being forced. From Blancco's perspective, our key solution is around promoting sustainability and the reuse of computer equipment. So it's something we've been happy to embrace. Within the last 18 months, we've set up groups within the business to focus on our own sustainability, though, because our product helps other companies be sustainable. We need to look at ourselves and how we can reduce our own carbon footprint, how we can be more carbon efficient, what things we can do to have a more diverse workforce and leadership team. And that's being now pushed down through the entire company, and it's coming from the board. So I would say up until 2 years ago, you probably get a cursory mention of ESG matters at a board meeting, and now a relatively significant part of the discussion, every single meeting will come about because of ESG matters.
So that really demonstrates the importance of responsible share ownership by investors. And it's great that it's expanding and it's becoming more prevalent. Just to go back a step, Rory, I'd love to know more about how you determine which companies are suitable for us to invest in, such as Blancco.
Sure, thanks, Olivia. Well, the first thing I would say is that we have a very, very disciplined way of working right across the whole sustainable fund range. We call it the BEST process, where B stands for business and financials, E is for environment and environmental issues, S is for social performance, and T is for transparency. What I think is the most important thing about the BEST process is that it is integrated from the alpha to omega of the investment process. So if we break it down into its very simple component features, our process works like this. First of all, we'll start off by defining which companies we will and won't invest in. This is the negative screen, if you like, that just cuts out all of the controversial activities that we don't want to be involved in. Secondly, once we do start researching companies from a financial point of view, we do an awful lot of valuation work to try and assess the intrinsic worth of each company that we're looking at. This takes a lot of time and requires a lot of experience, and we're all very, very keen on that area. However, we do feel it's really important to go into great detail on the EST of our process. And this is really where I think we set ourselves apart from our peers. We check all the areas of environmental impact, social performance. This includes things like employee diversity, training opportunities, engagement surveys, and we'll look at them over time, effectively carrying out an audit trail year on year. And we'll also look at governance issues, looking at areas such as board oversight, conflict of interest and independence of the board. I think what I would focus on is that we don't have a separate ESG team from the investment team. We have one team and we all do everything. This is probably quite rare in the industry, and if we look at a lot of our peers, they have two distinct teams feeding into an investment decision. So the entire team is involved in challenging an investment case brought to the table for consideration, and no stock will be purchased without which it undergoes a pretty severe scrutiny. I think the great thing is that the team is made up from a multidisciplinary background to ensure as much cognitive diversity as possible. You know, after all, we don't want a team that's made up entirely of economists or geologists or whatever, you know, because that brings about a risk of groupthink, and we need to minimise that.
Thank you, Rory. That's it ties in with our employee ownership status as well, that everybody has a say. And Amelia, in fact, you were a classics graduate, weren't you? Did Latin and ancient history at Edinburgh, talking about having a diverse team. And Rory was talking about negative screening. Could you tell us a little bit more about what that involves?
Of course. So I think really stemming from our background in investment for charity clients, we felt it was important to include that negative screen in our investment process so that our clients and investors can really get comfortable that our values align with their own, and also to provide as much transparency around that process as well. So the full policy is published on the website and reviewed annually at our stewardship committee meetings. So we really want to make sure that it's a moving sort of policy, keeps up with the times, and it ensures that it's keeping up to date with how our clients are thinking on that front as well. So the negative screening includes a number of key areas that we believe are unsustainable for investment just by their very nature. So this will include things such as fossil fuel generation and mining, and the manufacture and retail of alcohol and tobacco. We operate these screens using a maximum threshold level of 10%. So that is revenue or operating profit, whichever of the two is higher, to rule out any companies that have what we would deem to be material exposure to these industries. And as well as exclusions to particular industries or controversial activities, we also consider many criteria that are not so easily quantifiable when thinking about whether to screen out an investment. So these topics include labour standards, responsible marketing of products, as well as things like governance, which you mentioned before. And I think it is important as well, just to make the point that Rory sort of touched on earlier, that it's, as one of the earliest features of ethical investing, it is really a base of many investment processes and continues to be used widely across the industry. But it is really that first step when we start looking at companies for investment.
Thank you, Amelia. And I suppose there's a danger that if you don't include any negative screening, then you can get some dodgy companies in there. So I agree, it's good as a first step. And when we're talking to our clients on the financial planning side, we'll go through an ethical questionnaire with them. And it's at that point that we're sort of saying, what do you not want to include, as well as what do you want to support? And then that informs your work as well. So if we talk about stewardship and engagement next, could you explain exactly what that means, Amelia, and how we go about it at Castlefield?
Sure, thanks, Olivia. So the two often come hand in hand, really. Stewardship is about institutional investors acting in the interests of the beneficiaries. So in this case, our clients, and really having that ownership mentality when it comes to assets that we invest in. And then the way we'd maybe think about engagement is that can be seen as a way to put that stewardship role into effect. So building a role with investee companies for the benefit of the underlying shareholder. This is an especially important role for us, given our focus on responsible and sustainable investment, and particularly as long-term shareholders in investee companies. We do have quite a long-term horizon when we're thinking about investments, and so that's typically over 5 years, which means that our work really doesn't stop after that first investment decision-making process. We consider engagement a vital part of that ongoing process and dedicate a lot of time to speaking with company management about issues that we believe are important to our clients, as well as playing a role in long-term value creation. So topics we engage on vary widely and can cover governance concerns, such as a lack of independence on the board, environmental topics such as company targets to meet net zero or align with the Paris Climate Agreement, as well as social topics such as diversity, which has been a really big focus for us recently.
Thank you, Amelia. I'd like to go to Adam next and ask about your experience of engagement with Castlefield and how we maybe differ from other investors in Blancco.
Thanks, Olivia. So I first spoke with Castlefield probably around about 2 years ago. It had been around about the time that the company was awarded the Green Economy Mark by the London Stock Exchange. And it was an interesting first interaction for me because although I've been working as a CFO for public companies for 20 years, I've never really met an ethical investor before, what I thought really is an ethical investor. And the approach was very different. So it was very clear from the outset that there was a very different approach in terms of how Castlefield were looking at Blancco, and it was much more than we typically see with our traditional investors, where it's mainly financially driven and primarily around the market size. And whilst all of those things are very important, for Castlefield, there's clearly a wider range of interest that the guys at Castlefield had. So after that first meeting, we then completed the questionnaire, which again, I'd never been through that process before. No other investor has asked us to complete a questionnaire before they invest in us. And so that was a new thing, but actually something we really welcomed. But what I think I found particularly useful is I have no training in ESG matters. I've had to pick this stuff up as we go along, and I head up all of these issues for Blancco. And I use Castlefield as a consultant really to help me to understand what investors are looking for when they're looking at companies like Blancco. And that's been incredibly useful because whilst since meeting Castlefield, I've met a number of investors who are ethical investors or are bigger institutions with ethical specialists, the approach with Castlefield is very difficult. And as Rory said earlier, everybody seems to have an understanding of these matters. It isn't just assigned to one or two people within the organisation. And that really helps me when I go to you and ask for advice. And a good example was we produced our first ESG report last year. We went out to all our shareholders, and then we asked the company that helped us with it to get feedback from shareholders. And they went to our top 10, but I also asked them to go to Castlefield. So though you're not in the top 10, I knew that you would have some really constructive feedback for us in terms of the way that we approach ESG, and that certainly proved to be the case. So it is a very different approach, but it's something that's becoming less different, and more organisations I'm beginning to see do similar things, albeit in probably quite small cells within a bigger company.
That's great to hear, Adam, that we punch above our weight. So as ESG becomes more mainstream, there's certainly more of a risk of greenwash. Rory, can I ask you to define this and tell us what the red flags are that we should look out for?
Yeah, an interesting topic, Olivia, thank you. Look, in my personal opinion, greenwash is likely to be the next mis-selling scandal for this industry. Effectively, greenwash is the overlaying of plausible ESG criteria without actually going into the detail of the work. So it's labeling rather than working. It's corner cutting. It's a short way to getting over longer work processes. And these work processes are really, really important. It's too easy nowadays to buy in off-the-shelf solutions from some very big organizations. I won't name them. This is effectively outsourced data and information which captures ESG data and also provides scoring methodologies. This allows big firms with big budgets the ability to shortcut rather than do the actual work themselves. In our opinion, the data integrity and validity is left to possibly offshore analysts, possibly analysts who don't have a huge amount of experience in a particular industry or with a company, and certainly no understanding of client requirements. You'll also see a lot of AI, so artificial intelligence, picking up data. So that data, the quality of that data is less than the quantity, I would say. there is a place for the judicious purchase of data from outside, but I think that there's a major risk in the industry at the moment of an over-reliance on someone else's work. It's too easy, it's too cheap to outsource. It's available and it's within budget. I think it's not just cribbing. I think it's far from good practice, frankly. I suppose elsewhere, in terms of greenwash, there tends to be an additional skew towards the SDGs. This is the list of 17 development goals set out by the UN. And whilst there's much to praise about the goals themselves, we've seen quite a lot of focus and excessive use by investment houses who shoehorn their investment ideas into one or other of these goals. And we've seen some fairly specious arguments being used here. So I think for clients, you really want to have a good idea of how the ESG processes work, how much is done in-house and how much there is on reliance outside the organization, and whether that's really aligned with the client interests. What gives me hope, it's important to end up on the positive side, is that the companies themselves are really grasping the nettle. And we've heard Adam talking about this just now, really educating themselves on the issues and building very strong management information capabilities to understand and try and address the issues that are facing all of us. So, we're not without hope at all. I think we're on the right path, but there are risks of greenwash and clients do need to be careful of it.
Thank you, Rory. And to follow on the positive theme, Amelia, what would you say would be the characteristics or attributes of a company that's doing ESG properly?
Of course. So I think one of the difficulties with ESG, responsible, sustainable investing, is that there really is no one-size-fits-all approach. And I think that's one of the things that I would see as a true positive, is that it's the companies that acknowledge this by avoiding a tick box approach and that sort of, check off a list mentality, and instead focus on the issues that are the most important for their own business and are demonstrating a genuine commitment to addressing those. Are the companies that we see sort of head and shoulders above the rest. Really, it's quite easy to follow a list of things that you feel like you need to talk about, but if they're not relevant to the business, they're not something that you have the ability to change or improve, then it's less useful for investors to see that information. Instead, we want to see the focus on the most material issues and the things that the company has the most power to improve and really work on. So that's one thing that I think is really important. And secondly, I guess something else we find ourselves talking about quite frequently internally is culture. And that's something it's quite a soft factor, really, and can be very difficult to assess at times, but it's such a positive when we feel that management are genuinely on board with those company aims towards sustainability, and management teams that are leading when it comes to that corporate social responsibility agenda. So I suppose I just want to say thank you to Adam, really, for being such a good example of that, and I'm glad we could have him to speak on the webinar.
Thank you, Amelia. And my last question is actually for Adam. And I wanted to ask, what are the most important factors for Blancco when you're considering your ESG reporting, which ties in nicely with what Amelia was just talking about?
Yes, thanks, Olivia, and thanks also, Amelia, for being so kind about Blancco. But I think for us, I think we have to take a lot of what you guys were just saying there, and I think it's really important that we are clear that we're not going through a greenwashing exercise, and we're not just trying to tick boxes here to try and tell people what they want to hear. It's become a very complex area as well to report on, because the number of acronyms and standards that you need to potentially report against gets very confusing, and I think it's not helpful for investors. So I think for us, reporting in a very clear and concise way on the things that are very important to people is going to be a very key thing. I think also, whilst you're always naturally inclined to try and push the areas that you know you're very strong in, I think you also need to highlight the areas that you're not particularly strong in, and that you know you've got areas that you can improve in, and what you're going to do about it. Because I think it's very unlikely that there's any company out there that says we've done everything we can possibly do and we can't improve anymore. So I think everybody needs to keep looking at all areas, giving them all equal prominence, and making sure you've got clear plans in those areas where you don't have a strong story to tell at this time. And then I think, actually going back a little bit to what Amelia was saying just there are things that you can do in the softer parts of the business which perhaps you don't need to comply against. And often this might be more the social side of the reporting that just gives people a feeling for the culture of the business and what you're trying to do. And companies themselves need to embrace opportunities in this space. So as an example, for Blancco this year during the pandemic, we've donated over 2,000 licenses to enable used laptops to be repurposed and sent out to underprivileged children to be reused when they're needing to do remote working. And we're very happy to support that project, and hopefully that gives investors the understanding that this isn't just us trying to do better for carbon reporting or diversity, but actually it's a culture of the company. We want to do everything we can to be a responsible business and an attractive investment.
Thank you, Adam. That's really interesting. And that's all we've got time for today, but thank you for joining us. I'd like to thank our speakers, of course, particularly Adam, for taking the time to share his insights with us today. And there's a lot more information on our website, for example, our stewardship reports, our screening policy, and our winners and spinners reports that shines a light on some of the best and possibly the worst ethical funds from our perspective. And we'd love you to join us for future events. When we've recorded some, they'll be up on our website. And do, of course, get in touch if there's anything that you'd like to learn more about. Thank you.